Hey folks, how are you? Welcome to the video. So today's video, I'm going to be talking about technical analysis. What is technical analysis? Why is it helpful? Why is it unhelpful for new traders? And key things to focus on in regards to learning technical analysis and generally how it can be helpful if you're a short-term trader and you want to learn more about the markets. So technical analysis is a very useful tool when it comes to analyzing price moves in financial instruments. Let's go ahead and find the Investopedia definition. Technical analysis is a trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends gathered from trading activities such as price movement and volume. Right there, that's all you need to know. By analyzing statistical trends, that's a big word, gathered from trading activity such as price movement and volume. So those two things are going to be our top indicators in regards to technical analysis: price movement and volume. There are plenty of videos on the internet about technical analysis, so I'm not going to go deep into the nitty-gritty of how to understand price bars and stuff like that, because there's absolutely 1.5 million videos on that. But what I will tell you about is some brief topics about why I think technical analysis is helpful and why I think technical analysis could be unhelpful for newer traders. So let's get into that right away here. Why is technical analysis helpful? Well, I'll try and simplify it for you. I think technical analysis is helpful because it helps us to identify trends in the market. Now, what's a trend? Well, in trading and price action, we have two kinds of trends: an uptrend, a downtrend, or a trading range, basically where there's no actual present trend. This is a general rule of thumb, is that when a trend is present, it's usually likely that the trend will continue until too many people figure out that there's a trend, and then the trend is likely to reverse, because that's just psychology. Technical analysis by itself will not present a super useful tool, but technical analysis combined with other things like psychology of markets now presents some kind of interesting ideas here. Okay, if you can identify that there's a downtrend, you should definitely default to trading in the direction of that trend, even if a lot of the time the risk to reward may not be favorable for trading in the direction of the trend, because counter trend trades always have a better risk to reward than with trend trades. You still need to default to trading with that trend. Like I said before, it's human nature to want to call a top or call a bottom. When price is moving lower, it's in our human nature to want to buy, and when price is moving higher aggressively, it's in our human nature to want to short. I think that is the general thesis behind the reason why we get some very irrational price moves in these markets. So it's just a matter of disconnecting that natural human instinct of trying to call a top or call a bottom, all right? So try and stick with the trend. So in regards to technical analysis, trends are going to be probably your most helpful indicator. When using technical analysis, you want to be looking at trends on multiple time frames, depending on the time frames that you trade in. The beauty of some great charting platforms like TradingView, for example, is that we can use custom time frames and we can pretty much print price bars for almost any time frame possible, all the way down to like 5 seconds. A lot of times it's important to zoom out and look at larger term time frames. So an example of that is, let's say you trade the NASDAQ, and if you're looking at the hourly chart on the NASDAQ, it might look something like this. This is a 26-minute chart, but if you zoom out and look at a 6-hour chart, you can see something slightly different. So that's why it's important to use technical analysis to understand the trend on multiple time frames. These trends help us to identify where traders are likely positioned, and they can help us to measure our risk and make better trading decisions. So that is why technical analysis is helpful, in a simple way of explaining it. Okay, this brings us to the next point, which is why technical analysis may be unhelpful for newer traders. Okay, so this is a very common occurrence. So a newer trader gets into trading, he starts trading for whatever reason, and he's experiencing some success to start. Okay, he has a few winning trades and he thinks that he's unstoppable. Now, eventually, we all know that this is not going to last forever, and when he experiences his first sizable loss, he is now going to reconsider his decisions, and he's going to say, what did I do wrong? What can I do to improve myself? And likely he's going to try and say that he can improve his trading by learning more about the market and learning more about how to analyze the market through technical analysis. This is the danger right here. It's that newer traders think that learning technical analysis will help them to lower the risk in their trading, therefore eliminate the risk in their trading, because being a better market analyst generally will make you unstoppable in the market, right? Because you're able to analyze the trend and buy when the trend says to buy and sell when the trend says to sell. So a lot of newer traders are under the impression that technical analysis is a way of improving their market analysis, therefore improving their trading. That is 100% false, because when you're under the impression that technical analysis can improve your trading, then you think that there's no risk if you enter a trade at a certain moment. So that's the danger, is that technical analysis can convince you that there's no risk in a trade. You never want to be in that state. Technical analysis should be used as a tool to measure your risk, not to eliminate it, because it's impossible to eliminate risk, obviously. So the danger in technical analysis, I'll say it again, is that it provides an opportunity for traders to convince themselves that there is no risk in a trade. So I'll give the example here. A trader takes a trade and he thinks that, based on his newfound analysis about the market, that his trade is a winner. Because he is using his analysis and he is so sure about his analysis, when the trade goes against him, he is not going to know what to do, because he thought entering the trade that there was no risk. You see? So when he's under the pressure of the losing trade, now he's going to be in this cycle of trying to find any possible reason to make his trade a winner. So he's going to be scrolling through a whole bunch of different charts and looking at all kinds of different types of data to try and come up with the idea as to why his trade is still a winner, even though the market is clearly moving against him. So that's what you call analysis paralysis. You never want to get into that state, because you've lost control at that point. If you're looking at a chart and you are being blinded by the information in front of you, you're only focusing on the information that's moving in your favor and completely being oblivious to the information that's moving out of your favor, you've essentially entered one of the darkest places you can enter, which is essentially you've gone past that point of no return and you are now oblivious to what is actually happening. You're not viewing market information as objective anymore. You're only focusing on what's in your favor, because you thought that your analysis was going to be your savior and that you were eliminating the risk by having such a great analysis. So that's the danger of technical analysis. So newer traders, do not focus on technical analysis as a means of lowering risk. You need to understand the purpose of technical analysis, and it's simply to identify trends in a market, to make slightly better trading decisions, to help identify where traders are likely positioned in a market, and to potentially trade against the direction of certain trap traders if that happens. Technical analysis is not a means of lowering risk, but it is a means of coming up with trading opportunities and measuring risk, of course. Cool. The key things to focus on in regards to technical analysis, number one is the trend. What is a trend? An uptrend consists of prices moving in higher highs and higher lows. Once we lose an uptrend, we can now say that we are in no trend or in a downtrend. So you can see here, the NASDAQ was in a 6-hour uptrend, higher low, higher high, and then we finally lost this higher low here at this price. So you could say at this point, we were no longer in a 6-hour uptrend, which means that now the more likely scenario was going to be some sort of lower high here. This happens a lot, where the market will pretend to lose a trend, but then find no follow through in the direction of the lost trend. And now it's going to regain the trend and shake out any traders who attempted to sell the market. Like in this case right here, many traders entered short on this bar and then they managed to get stopped out by the market just not finding any more sellers down here or here, and we managed to kind of move higher slowly. So that is the nature of trends, okay? So an uptrend, a downtrend, a trading range. What we can do is analyze trends on multiple time frames to help identify what is the most likely scenario, okay? And that is where our key price points come into play here on charts. One thing I learned from watching the Chart Guys for many months, shout out to the Chart Guys, they're the best technical analysis channel on YouTube, is that multiple time frame technical analysis is one of the most important things that a trader can do. On top of that, you should be looking to find the most clarity on certain time frames, right? So you should cycle through multiple time frames to find the one with the most clarity. So one example I can give is that a loss of a trend on one time frame can signal something to change on another time frame, okay? So for example, the NASDAQ is still in a 4-hour uptrend because we're holding this higher low right here. Now, if we were to lose that higher low, now the odds would be starting to shift towards the bears, because we're now moving closer to this daily pivot area, where that would be, in my opinion, the level that would have to be lost. So you can see that if we lost the 4-hour uptrend, it would probably spark some panic, because some longs that entered here and here would probably be forced to exit the trade. So losing that 4-hour uptrend would signal some daily consolidation that might be nearby. So the time frames I like to use personally is for day trading, I focus on the 2-minute and 5-minute charts, but sometimes for clarity, I will look at an hourly or 26-minute chart. The reason I like to use a 26-minute time frame is because it actually divides our trading session into 15 equal bars. But anyhow, you can try and find whatever time frame you like the best. And like I said, I recommend you cycling through the time frames that you find most clear. So for certain commodity markets, since they trade around the clock, it makes sense to shift through some different time frames like 6-hour or 12-hour, and you can see these trends on the larger time frames and they can give you more insight. Whereas looking at a plain, 30-minute chart on natural gas might not give you as much insight as, for example, a 4-hour chart or a 10-hour chart. All right, guys, so again, I'm gonna just highlight the key things to focus on in regards to technical analysis, and then I'm gonna end the video. Number one is trends. Learn about how trends interact in the market. Learn about how uptrends react. So when the market is in an hourly uptrend and then we lose the 5-minute uptrend, it is a likely chance that our hourly temporary top is going to be set for now. When a certain shorter time frame trend is lost, it signals that a larger time frame level might be in. You can see how this sort of analysis can help you with identifying probabilities in the market, therefore helping your trading decisions and risk to reward. The next thing you want to focus on is price bar analysis. Okay, so I'm not going to really talk about price bars because there's a million videos about learning how to read price bars, but generally there's two kinds of price bars in my opinion. There's trend bars and doji bars. So a trend bar is basically a bar that has a large body and that is usually showing a strength in one direction or another. So this is an example of a bull trend bar on this 5-minute chart. A doji bar would generally be any bar with a small body and there might be an upper or lower wick. So a doji bar generally signals indecision or some form of price rejection in either direction. Don't be so obsessed with doji bars because a lot of the time the market might paint false doji bars. So you might see a doji bar form. It might be a kind of a reversal shaped candlestick. Sometimes you see that. It doesn't necessarily mean we're seeing a reversal because actually I would think that there's algos out there programmed to make doji bars appear. So in the last few seconds of a bar forming, an algo might buy or sell to make that bar look a certain way to make a newer trader anticipate that a reversal is likely when in fact a reversal is nowhere near close, okay? So you need to understand that's why it's important to use multiple time frames. So don't always use one time frame and look for dojis everywhere, okay? Remember, the trend is likely to continue, so don't trade solely off of price bar analysis. The last thing you need to understand is volume. Volume is a good indicator. So on TradingView, volume is quite clearly displayed down at the bottom of the chart, and you can also add a volume MA, which is a moving average showing you the average volume that tends to occur on whatever time frame you're trading. So you can combine these kinds of concepts with something like tape reading to help you identify likely trading setups. For example, if you see a held bid at a certain price and it's also accompanied by a lot of volume, that might be a signal to get long. So that's just an example. All right, guys, so I hope this video helped you to identify what is technical analysis, how is it helpful, and how it might be unhelpful for a newer traders. Guys, if you liked the video, please leave a thumbs up and I'll see you in the next video. Take care. Bye.